Good morning. Today's topic is dissolution of partnership and partnership firm. Now, what is the meaning of dissolution first of all? The literary meaning of dissolution is undoing or breaking of a bond. If there is a relation and that relationship or arrangement is going to be changed, then also the bond is broken up. Similarly, in case of a partnership, when there is some reason, rather just like your admission of a partner, retirement of a partner, even changes in the death of a partner, changes in the profit sharing ratio, whatever arrangement was there, if it is changed, it is called dissolution of partnership. But on the other hand, dissolution of partnership firm is something more grave in comparison to the dissolution of partnership. That is because in case of dissolution of partnership, the business continues, but in case of dissolution of partnership firm, the business comes to an end and all the assets are sold away, all the liabilities are paid. Like this, the whole thing comes to a stop. So, there is much difference between dissolution of partnership and dissolution of a partnership firm. This dissolution of partnership firm is dealt with from section 39 to section 44 of the Indian Partnership Act 1932. Now, I am coming to the dissolution of a firm. Dissolution of a firm can take place in many ways. First one is dissolution by agreement. A firm dissolves when all the partners give consent to it. Suppose there are three partners, all the three partners agree that let us come to an end, let us close the business. So, business firm can be closed and dissolution of firm can take place. Similarly, as per the partnership agreement, if it will be for a certain period, after that period is over, automatically it comes to an end. So, these are the two cases when dissolution by agreement is possible. Then coming to the compulsory dissolution, there are some cases where there will be compulsory dissolution. A firm dissolves compulsorily in the case of number 1, where all the partners or all except one partner become insolvent. All the partners when become insolvent, naturally nobody is in a position to sign any agreement, enter into a contract. So, naturally the business firm will have to be, the partnership firm will have to be dissolved. All but one, when all but one partners are insolvent, only one partner is solvent, only he can do. So, that does not become a partnership, that becomes a sole trading organization. So, the partnership firm has to dissolve when all or one but all partners are declared insolvent. Secondly, where the business becomes illegal. Previously it was legal, but due to the legislations, rules, the government suppose bans it. Suppose we have got business relation, trade relations with Pakistan and a war breaks out between Pakistan and India. So, automatically all the relations will be cut off and any business with Pakistan will be declared as illegal. So, in that case the partnership firm also dissolves. When all partners or one but all partners decide to retire from the business, from the partnership firm, then also it comes to an end. Then when similarly when all partners are only one partner is alive and other partners die, then naturally it will come to an end. where the partnership deed includes any provision regarding the happening of the followings, that is expiry of the period. That means, if it is if the business was only for 2 years, after 2 years it will come to an end. If it was for 10 years, after 10 years it will come to an end. Similarly, completion of the specific venture. Suppose the partnership firm has taken a venture to construct a building or a bridge. After the completion of the bridge, naturally it comes to an end, because the venture has already been completed. Then the dissolution by notice. In case of partnership at will, simply one notice if will be served by one of the partners in writing, then also the partnership firm dissolves, that is by notice. Then dissolution by court. If any one or more partners go to the court of law because they are not satisfied to continue the business, they can apply to the court, and the court, if thinks proper, then can order to dissolve the firm. The whole firm will be dissolved according to the order of the court. So, what are the circumstances? The first is when a partner becomes insane. When a partner becomes insane, all the other partners or one of the partners, remaining partners, suppose go to the court of law, and under this plea apply for dissolution of the firm, the court will order to close the firm. Secondly, a partner becomes permanently incapable. So, he will not be in a position to work anymore. So, in that case also you can go to the court of law, the other partners can go to the court of law, and they can apply for the dissolution of the firm. Third one is a partner deliberately and consistently commits breach of contract or breach of agreements. Suppose there are 3 partners, each partner is being given one department, say one purchase department, one sales department, one administration department. But the person who is in charge of sales department, suppose he interferes in the work of the other 2. So, in that case also the other 2 partners have got the liberty to go to the court of law and apply for dissolution of the firm. Then, when a partner's conduct is likely to adversely affect the business, suppose one partner is not of good, he is not having good behavior. Any customer comes, he behaves very rudely. So, naturally, if it is consistent and it will lead to only loss, naturally other partners can go to the court of law and ask the court, request the court with a prayer that please dissolve the firm. So, that can be done. Then a partner transfers whole of his interest. Actually, no partner can sell his share to another person without the consent of others. So, if one partner makes any breach of contract, he transfers, suppose Mr. A had transferred his share to his son B, it is not possible. Provided other partners agree, then only it will be possible. If without the permission of, without the consent of other partners he has done it, on this ground they can go to the court of law. Then lastly, when the business cannot run without any loss, if the business will run, there will be loss and loss. So, in that case also you can go to the court of law. And besides these facts, also if on any other ground a partner goes to the court of law and the court of law is satisfied that actually there is reason to close the business, to dissolve the firm, it can order so. So, this is regarding your dissolution of different types. At the time of dissolution of a partnership firm, how the accounts will be settled? First of all the assets will be sold away, all the liabilities will be paid, that is the claimants will get it, that is according to section 48 of the Partnership Act provides that the following routes for the settlement of accounts between the partners will have to be made. First of all, loss, this is section 48. First of all, we will discuss about loss. If there is any loss of the business, it will be made up out of profits, next out of capital, and lastly by the partners individually in their profit sharing ratio. So, losses will be first of all made out of the profits of the firm, accumulated profits if there, that will be made up, that will be utilized for making up the losses. Similarly, if loss is still more, out of capital of the partners it can be made up. If it is also not sufficient, the partners will have to give it personally because of unlimited liability of the partners. Then number 2 is assets. On the dissolution of a firm, the assets will be sold, and if there is any contribution by any partner also, that will be added. The total amount thus will have to be distributed, and how it will be distributed. It will be given first of all the payment of expenses. Payment of expenses, that is realization expenses. In order to realize the assets, there may be some expenses. That expenses will have to be paid up first and foremost. Number 2 is payment to outsiders liability. So, out of the sale proceeds of all the assets, after making the payments of expenses of dissolution, that is realization expenses, then outside liabilities if any will have to be paid, like sundry creditors, bills payable, etc., that will have to be paid, even bank overdraft, that will be paid. Then if still remains some cash is remaining, that can be utilized for giving up or can for payment of repayment of loan, repayment of partners loan. Repayment of partners loan. If any partner has advanced any loan to the firm over and above his capital, then that amount can be given or can be paid out of the remaining balance. Suppose again some cash is remaining, who will take it? Then it will be utilized for repayment of capital. All these amounts will be paid ratably. Ratably means if suppose there are 3 partners, they have given 10,000, 20,000 and 40,000. So, ratably it will be given. Suppose we have got only 6,000. So, 1,000, 2,000 and 3,000, like this it will be given. Then if there is any surplus, that will be distributed in the profit sharing ratio. So, in this way the assets and the contributions by the partners will be utilized first for the payment of expenses of realization, then outside liability will be paid, then if balance is there, that will be partners loan will be paid ratably, and then repayment of capital, and lastly the surplus will be distributed as profit and in the profit sharing ratio. the partnership firm might have got some assets or properties and also some debts or liabilities. Similarly, so far as the private part is private property of the partners individually are concerned, they must have some private property and must have private debts also. So, here we have to remember the private property, although is attachable to the partners, the partnership firm's loan, still then private property will be first utilized for private debts. If there is some balance, that can go to the partnership firm. Similarly, partnership firm's debts will be first met out of the partnership assets. If there is something remaining balance, that will be distributed or that will be given to the individual partners' private debts. So, this is regarding the accounting treatment. Now, we will be coming to the journal entries. When the partnership firm will be dissolved, one realization account will be opened, that is very important. So, here first of all we have to open one realization account, and this realization account is the main account because it will spell out the profit or loss on realization. That means, when the partnership firm will be dissolved, all the assets will be closed, their accounts will be closed, all the liabilities account will be closed and all will be transferred to the realization account. Everything will have to be done through the realization account. So, the first entry for transferring the assets to realization account will be realization account debited to asset account. As you know, asset account is showing a debit balance. So, realization account debited to assets account individually at book value. Let us get the justification of this entry. When assets are there and it has to be disposed of, it will not be directly disposed of, but it will be disposed of through the realization account. We are opening one realization account which is nominal in nature in order to spell out the profit or loss, that will give us the profit or loss, that is why the realization account has been opened. So, all the assets will have to be transferred individually at their book values, that means that will be closed. So, these accounts will be transferred, but here we will not take cash account, cash at bank account, etc., and the fictitious assets account. Will not the fictitious assets like will not take the fictitious assets like suppose preliminary expenses, or you can say discounts or something like that, or profit and loss account debit balance, all these things will not be transferred. That will be transferred later, I shall tell you how. But now suppose sundry debtors are 20,000 and there is a provision of 2,000, provision for doubtful debts. So, we have to transfer 20,000 here, not 2,000. That is because provision for doubtful debts and sundry debtors are two separate accounts. Provision for doubtful debts will be transferred when we will be transferring the liabilities. Now, the second entry is for transferring the liabilities. As you know, the liabilities account are showing credit balances. To close them, liabilities account debited again individually at book value to realization account. So, this is just the opposite entry. So, here liabilities means only the outsiders liabilities. We will take creditors, we will take bills payable, bank overdraft, etc. But we cannot take the accumulated profits which is appearing in the liability side of the balance sheet, like general reserve, reserve fund, etc. That will not be taken into account. So, this is regarding the liabilities. Similarly, the provision for doubtful debts also can be transferred here to realization account. Provision for doubtful debts account debited to realization account, like this. Third entry is for sale of assets. Now, the assets will be sold. When the assets will be sold, we will be realizing cash. So, cash or bank account debited to asset account with the realizable value, not with the book value, but with the value realized. Similarly, number 4 entry will be for the payment to the creditors or the liabilities. In that case, we will write bank account will be credited and realization account debited. It is not the particular liability account which will be debited or credited, because we have already merged all the liabilities to the realization account. That is why. So, the particular liability account, for the particular liability account or all the liabilities when paid, the entry will be realization account debited to bank account with the amount paid towards the liabilities. Then coming to the settlement of creditors through transfer of assets. When suppose sundry creditors are 50,000, sundry debtors are 60,000, the creditors want to take the whole debtors of 60,000 for their 50,000, will not pass any other entry if it is for the entire sum. But for 50,000, if they take 60,000, but in addition another 5,000 rupees in cash, we will be passing only one entry, that is only for cash 5,000. So, that will not be paid, or that will be just realization account debited to bank account for the difference, but not for the remaining amount. Then if he pays, suppose 60,000 rupees debtors are there, creditors are 50,000. Now, they agree to take the debtors and give only 5,000 rupees to us. In full settlement of the creditors, they take all the debtors and they will give us 5,000. So, only this 5,000 entry will be there, that entry will be bank account debited to realization account. Then coming to expenses of realization. When expenses of realization will be there, that will be realization account debited to bank account if we are spending it out of the firm's cash balance. If some partner agrees to give on behalf of the partnership firm, he agrees to give the amount, but later on he will take it, then we can make a credit to him. The entry will be realization account debited to that partner's capital account who agrees to give it for the time being. Then when liabilities are paid off, realization account debited to bank account, we have to ensure that all the liabilities are paid. So, the entry will be realization account debited to bank regarding the payment of liabilities. Then when a partner discharges a liability, suppose one bills payable is for 5,000, suppose partner A agrees to discharge it. So, we can write realization account debited to Mr. A's capital account, because he has agreed to discharge the liability, he is taking that charge. Similarly, for realization of any unrecorded asset, suppose one asset was there, but it was not recorded previously, now it is fetching some value. So, the entry will be bank account debited to realization account. Just the opposite will be a liability which was not shown in the books of accounts, but now it is cropping up. So, we have to pay some amount. So, we can say realization account debited to bank account for that liability. If a liability is unrecorded liability taken over by a partner, then it will be realization account debited to partner's capital account. When the profit or loss on realization is determined, by preparing all these things, we are in a position to find out whether there is profit or loss on realization. The realization account will be closed, and if the credit side is more, there is profit, and this profit will be transferred to the partner's capital account. The entry will be realization account debited to A, to B, to C in their profit sharing ratio, that is realization profit. On the other hand, if the debit side of the realization account is more, there will be blank in the credit side, we can write by loss on realization transferred to capital accounts of A, B, C in their profit sharing ratio. Then the reserves etc., that is accumulated profits, profit and loss account, credit balance, reserve fund, general reserve, workmen's accident fund, accepting the liabilities etc. So, these are all accumulated profits. These accumulated profits will have to be distributed among the partners. So, when the partners will be entitled to get it, their capital account will be created, and this reserve account, reserve fund account, etc., profit and loss account, credit balance, etc., will be debited, so that it will come to an end and the partner's capital account will be getting a credit. Similarly, if there is accumulated losses like profit and loss account, debit balance is appearing in the balance sheet. So, that is showing a debit balance, that has to be credited, and who will be debited? The partners capital accounts will be debited in the profit sharing ratio. Then partners loan will have to be paid. Partners loan when will be paid? We must have opened partners loan account, which is in the liability side of the balance sheet. So, that account will be closed, means that account will be debited and cash account or bank account will be credited. Here I would like to inform you one thing more, that is when a partner's wife has given some loan, it is just treated as outsider's loan, not as a partner's loan. Then we will come to settlement of capital accounts. Now, the capital accounts will be prepared and the capital accounts which are showing more credit balance than their debit total, they will be getting cash. So, in the debit side we can write partners capital account debited to cash or bank account. On the other hand, if their debit balance is more but credit balance is less, by bank this much, their capital accounts will be credited by bank or bank account. When they will bring cash, bank account debited to their capital account. So, capital account will be credited by bank or cash. So, with this the accounts will be closed. Now, we can take one example and solve the problem. I shall tell you the journal entries, but prepare the ledger accounts. This is a question. The following the balance sheet of Anju and Manju, there are two partners Anju and Manju, sharing profits in the ratio of 3:2 as on December 31st, 2017. Balance sheet as on December 31st, 2017 is given to us. So, creditors 19,000, loan by Anju's brother 5,000, loan by Manju 7,500, general reserve 1,250, capital Anju 5,000, Manju 4,000, profit and loss account, credit balance 2,500. In this, the total comes to 41,750. And here in the asset side, plant and machinery 14,000, furniture and fixtures 2,000, investment 5,000, stock 3,000, debtors 10,000 less provision 500, provision for doubtful debts. So, 9,500, bank 5,750, total 41,750. The firm was dissolved on 31st March 2017. As a result, Anju took over investments at an agreed value of 4,000 and agreed to pay loan taken from her brother. Then realization of assets is as follows: stock 2,500, debtors 9,250, furniture and fixtures 2,250, plant and machinery 12,500. Expenses of realization were rupees 300. Creditors allowed 2.5% discount in full settlement, record necessary journal entries and close the books of the firm. So, I shall tell you the journal entries and we will prepare the necessary ledger accounts. So, what are the necessary ledger accounts? We can prepare one realization account first of all, then capital account of Anju and capital account of Manju, and then we can prepare Manju's loan account because Manju is a partner, then the bank account. It is important to remember, if the bank account is closed automatically, then your problem is correct. Just like while preparing the balance sheet in case of a final account, if the balance sheet tallies, both the sides are equal, then you can be assured that your problem is correct. Similarly, here the concluding proof that your problem is correct will be given by the bank account. So, the bank account automatically should be closed. Let us see whether we can close it automatically or not. Now, come to the entries. We will be opening one realization account. Then the capital accounts of two partners. One is Manju, another is Anju. Then we can have the bank account, of course, and one is Manju's loan account. First of all, creditors are 19,000, they will be paid. So, when we are going to transfer the assets and liabilities, first of all the assets, when we are opening one realization account will be credited and the liabilities account will be debited. So, creditors 19,000, we can write realization account debited to creditors. So, creditors account which was showing a credit balance will be now closed, because the entry is, I am sorry, realization account debited to creditors means it will be creditors account debited to realization, I am sorry, it will be creditors account debited to realization account. So, when creditors account will be debited to realization account is credited by creditors 19,000. Then loan by Anju's brother is also an outsider. So, loan by Anju's brother 5,000, by loan from Anju's brother 5,000. Then loan by Manju 7,500. So, Manju's loan account will be by balance brought down by balance brought down 7,500. Then general reserve is 1,250, will come to that, it will be distributed among the partners in their profit sharing ratio, and what is their profit sharing ratio? 3:2. So, the general reserve will be there. Before that, let us write the capital accounts. By balance brought down Anju is 5,000 and Manju 4,000. Then as we have discussed, this general reserve is an accumulated profit. That general reserve will have to be directly debited, so that it will be closed, and the credit will go to the partners Anju and Manju in their profit sharing ratio of 3:2. So, that is 1,250. 1,250 distributed in the ratio of 3/5 and 2/5. 2/5 will be 1,250 divided by 5 into 3 gives you 750. So, it will be by general reserve 750 and 500. Total is 1250. Similarly, there is another item also, that is profit and loss account. Credit balance is there 2500, that will be also credited here by PL account. Total amount is 2500 divided by 5, that is 500 into 3 1500 and 5000 into 2 1000. Like this it will be credited to the partners capital accounts. So, we have exhausted all the things in the liability side. Now, we will come to asset side. For the closing the assets, because the assets are all debit balances, they will be credited. When they will be credited, what will be debited? Realization account will be debited. Realization account debited to plant and machinery rupees 14,000. Then furniture and fixture 2,000 to furniture and fixtures, all these are the book values. Then investment 5,000, then stock 3,000, lastly debtors 10,000. And by provision for doubtful debts 500. Bank balance will be recorded here in the bank account, two balance brought down. Two balance brought down 5,750. So, we have posted two different accounts from the balance sheet asset side. Now, we will go to the adjustments. The firm was dissolved and Anju took over the investments at an agreed value of rupees 4,000. So, when investments are taken over by Anju for 4,000 rupees, the entry will be Anju account will be debited. Anju account debited to investment we cannot write. Why? Because investment account has lost its identity by merging into the realization account. So, for this 5,000 rupees we are getting 4,000 rupees from Anju. So, Anju account debited to realization account, let me write R means realization account, to realization account 4,000. Then in addition she agreed to pay loan taken from her brother, that means for that she will be getting a credit. This loan is adjusted 5,000 rupees, that will be paid by Anju. So, Anju account will be credited by again realization, that is loan, for the loan 5,000. So, we have discharged this liability and also realized these assets, We have to be very particular about these things, because these creditors will have to be paid, that is a liability. These assets will have to be sold and cash will have to be realized. One and I mean individually all the assets and all the liabilities had to be realized. Then realization of assets is as follows: stock rupees 2,500, stock 2,500, then debtors 9,250, debtors 9,250, then furniture and fixture 2,250, 2,250 furniture and fixtures, and plant and machinery 12,500, 12,500. Why I have written all these things is to take the total in one go, that is 1, 26,500. We are realizing 26,500. So, bank account debited to realization account, sale of assets 26,500. If the entry is bank account debited to realization account will be created by bank. By bank 26,500. In one entry we can do that. Then expenses of realization were rupees 300, that is the entry bank account realization account debited to bank account. Realization account debited to bank account $300. If realization account debited to bank account is created by realization account. Then creditors allowed 2.5% discount in full settlement. So, out of 19,000 minus discount 2.5%. So, 19,000 minus 2.5%, 19,000 into 2.5% is equal to 475. That will be deducted and the remaining 18,525 rupees will be given to the creditors. So, what will be the entry? Realization account debited to bank account. So, you can ensure here that all the liabilities are paid off. To bank, within bracket creditors you can write, we are giving 18,525. So, with this now we can compare the realization account and see whether there is profit or loss. Now, coming to the realization account, we have got, let us take the totals of both the sides and see whether there is profit or loss. This 5,000 by realization account 5,000. So, realization account debited to Anju we have not taken. To Anju brothers loan 5,000. Always pass the entry in both the sides. This is 5,000, 5,000 and for this 4,000 we have also not taken realization account, capital account of Anju debited to realization account is created by Anju's capital 4,000. So, here we have got sundry creditors 19,000, then provision for doubtful debts 500, loan from Anju's brother 5,000, 26,500 all the assets realized and then Anju's capital 4,000 and coming to this side we have taken stock, debtors, furniture, stock, debtors, furniture, then 3, 10, 2. Plant and machinery 14,000, investments 5,000, Anju's capital 5,000, 300, 18,525. Now, we will take the total and there is a loss. Let us see this side. This side looks to be greater than this. So, 5, 2, 8, the total comes to 57,825. and this side is coming to 1000, carry 1 to 55,000. That means 2,825 will be the loss. So, we can write by loss on realization to 2,825 will distribute in the profit sharing ratio of 3:2 between Anju and Manju. So, here we can write 2 Anju and Manju. So, 2825 divided by 5 multiplied by 3 is equal to 1695. 1695 and 1695 minus 2825. 2825 1130. So, in this way it will be 2,825. Now, these two things, that is realization account created by Anju and Manju. So, Anju and Manju account debited to realization, ultimately loss, that is coming to 1695 and 1130. Then now coming to the position of the bank, how much we have got? We have got 31,000, more than 31,000, some 32,250 minus 300. So, almost 31,000 something. So, 7,500, that is the loan of Manju, can be very well given. So, right here to bank 7,500. So, that this account is closed. So, bank account is created by Manju's loan 7,500. Then we will close the capital accounts, because realization account is closed. Now, this Manju's loan account is closed, only capital account is there and bank account is there. Now, capital account will be closed. No need of keeping any space for the balance, because the accounts will have to be closed. Now, come to Anju. Anju has got more credit, that is 250, carry 1, 2, 5, 7, 5, 12, 12,250, 2 cash or 2 bank, balancing figure will be there, that will be 12,250 minus 1695 minus 4,000. So, this will be 6,555. Anju's profit and loss account, we have taken 1,500 on the credit side. Anyway, ours is coming 6,555. So, bank account credited by Anju's capital account 6,555. Then coming to this account, again this is also bigger, 5,500 minus this 5,500 minus 1130, 4,370. 370. Capital account of Manju debited to bank. So, bank account is credited by Manju's capital account. $4370. When I have given creditors 18,525 bank account by realization 18,525. So, this way we can get the total equal to 3250. So, in both the sides it will be 32,250. So, in this way we will prepare the realization account, then bank account, capital account and Manju's loan account, that is partner's loan account, and close the account. So, in the next class we will discuss about the insolvency of a partner or partners. Thank you.